In this video, we're going to take a deep dive into the RSI indicator, the Relative Strength Index. And this is the market timer. There is a reason the Relative Strength Index, or RSI, is a favorite among traders. It's like a momentum thermometer for any stock or market. Unfortunately, most who use the RSI indicator are not using it to its full potential. Most will use it simply for overbought and oversold conditions, and it is effective for that, as we will delve into later in this video. But for now, what we're going to do is we're going to look at different ways the RSI can be used that most do not use it for. So let's get right into it. The first one is the 50% line, right here in the middle. Now, I happen to have this RSI indicator on my TradingView chart, but you'll find that the RSI indicator is available on multiple charting platforms. In this case, I have it set in settings so that my upper band is at 70. There's the middle band that we're going to be talking about now, and the lower band is at 30. This is pretty standard, and most would consider it the default settings. Now, when you look at the RSI indicator and you divide it by an upper and a lower half at the 50 line, it tells you a lot about who's in control of the market, whether it be the bears or the bulls. In this area right up here at 50 and above, when the RSI line is trading in this zone, this is telling us that the bulls are in control. For example, we can see that the RSI is spending most of its time above the 50 from, say, here all the way to around here. Then it dips down for a little bit, returns to the upper end again, and then stays down in the lower end a lot longer down here. So just taking a look at this part right here, and then you can follow this cross cursor. As I put it here, you can look up here. Note that the bulls are control from here to pretty much to here when it starts to now go below the 50. And if you match it to up here where the chart is, you can see that the bulls overall were in control from here to here. Okay, we can see that the RSI has been hanging out below the 50. And if you come up here, you can see that the bears are indeed in control from here to here before it then takes off here. We can see that it returned below the 50 there to about there, and that would be right here to right here. And you can see that that is indicating the bears are in control while the RSI is below the 50. Give it the green for bullish. We can see it crossed above the 50 and it stayed up here up until here. And we can see that from here to here, the bulls were definitely in control. Now we're going to talk about divergence, bullish divergences and bearish divergences. This is another powerful use of the RSI indicator. And we have an excellent example for us right here in this love chart, LUV. Notice that after the RSI, in this case, had gone overbought, made a top, broke down below the 70, confirming that we likely have a swing top in play here, and then prices dropped all the way down to here, and in this case, oversold, but it doesn't have to be. It's the pattern we're looking for. Notice as it makes its bottom low here and then rises, it makes a bottom here, again oversold in this case, it rises here. But then what follows? We see that in this case, prices then proceeded to make a lower low than it made here. And if you were to put a trend line, it would look like this, a downward slope. However, the RSI failed to do the same. Notice that when it made a bottom, the RSI made a bottom. When it went up to make this peak, the RSI made its peak. Then as prices dropped to make this bottom, the RSI then proceeded to make this bottom. But lo and behold, this bottom is higher than this bottom, whereas this bottom is lower than this bottom. Notice the angles here. We have this descending angle, we have an ascending angle on the RSI. What we have here is called a bullish divergence. And what that often will signify is that we have a bottom likely occurring here. Being that it is a bullish divergence, we look for prices to likely start moving up as it did here. Now let's take a look at another example. Notice that the RSI is making a high here. Actually, it reached above the 70, doesn't have to, but it did. Then it moved down and the RSI moved down. Then prices moved higher, making a higher high than the previous high. The RSI moved up to make its peak high, but look, it is lower than the previous high. Then price proceeded to move lower. The RSI moved lower. Then price moved even higher still than the previous high, which was higher than the previous high to it. Yet the RSI once again failed to duplicate what the price did, making a lower high than the previous high than the previous high. If you were to apply a trend line to this, you would see that here it's sloping up, but in the RSI pattern, it is sloping down. In this case, what we have is called a bearish divergence. And it is likely that prices are going to start moving lower, as it did here. And it's not done yet. It's still early. We may be moving even lower still. But you can see what the pattern is showing here, and you can understand that when you see a bearish divergence, it is best that you prepare for prices to likely start moving lower, and when you have a bullish divergence, to start expecting prices to move up. Here is another example. Here we have prices moving lower to bottom here, and we see that the RSI was moving lower to bottom here. Then we see that prices move up, and we see that the RSI moved up. Then prices started to move down again, making a substantial lower low on the price chart. And we can put a trend line there so we can look at the angle of descent. But here, notice that we did not make a lower low of any significance whatsoever. If anything, it's virtually an equal low. You can see that the patterns are not the same, which is what you would expect if the RSI is mimicking price action. This is a strong indication that we have a divergence, a bullish divergence, and then we are likely to see prices start to rise. And that is exactly what has happened here. Here's another small example. Again, we have a low, and in the RSI we have the low, then it's followed by an even lower low. However, on the RSI it is not. This is a bullish divergence. Expect prices likely to move higher. There are also very subtle divergences, so I want to include it here for you, though it's not what you would commonly be looking for, but you should be aware of it. Notice here where prices had moved up and have pretty much moved sideways. I will put a trend line here marking the two tops, and it looks something like that. But if you come down here and you look at the RSI, for example, you'll notice that there is a much steeper angle of descent, although in this case not as great as the other examples. But what you want to be mindful of is that this is hinting that you have yourself a bearish momentum situation developing here. Because the RSI, which is a relative strength index, is telling us that the relative strength here is weaker than the relative strength here. Even though the price may be somewhat at the same level, the strength here is weaker than here. It's like looking under the hood and seeing what's really happening between the bulls and the bears and being prepared for it. And as you can see here, in a couple of days, it had severely gapped down to the point of even going oversold, as shown here. Okay, so that wraps up bullish and bearish divergences. Okay, so now we will talk about using the RSI for what it's commonly used for, and that is for overbought and oversold conditions. Now, the upper line I have here is the 70, and this marks the overbought zone from 70 above. Here's the 30. It marks the oversold zone from 30 and below. Later on in this video, we'll talk about those RSI moves that fall just short of the 70 or the 30. But for now, we're going to focus simply on the overbought zone and the oversold zone. Okay, it should be noted that the scale of an RSI indicator is usually from 0 to 100. So from 70 to 100, we would call the overbought zone. From 30 down to 0 would be the oversold zone. Now, as you can see in this example, we're using LUV, the Southwest Airlines stock. As the RSI moves above the 70, starts trading above the 70, it is now in the overbought zone. And you can see how this corresponds with this high right here. Now, for confirmation, you want to wait for the RSI to drop back down below 70. At this point, as it starts to drop below 70, then we can feel confident that we have put in a short-term top. You can see why this is important when you look over here. For when the RSI crosses into the overbought zone, it could stay there for a little while. So you would not want to assume that as soon as price moves into the overbought area, and the RSI as well here, that it's ready to make a top, because as you can see, it has not done so, but yet continues to move higher. But notice what happens as you continue to move over to the right, and then you see that the RSI is crossing below the 70. Now you're putting in a short-term swing top, and in this case it's the 4-hour time frame. Here you can see, for example, that the RSI has moved down into the oversold zone. This was after it had been moving down quite a bit. But it is when it has moved back up above the 30 line here that you can feel confident that you have your short-term swing bottom in. Now in this particular case, that was short-lived. It had a big move in 2 days, or should I say 8 hours, but then moved a little bit lower before continuing on. Okay, so here is another example of oversold condition. Here we see that the RSI is trading down in the oversold zone, that is below the 30 line. Then it makes a move up above the 30 line, indicating that a bottom may be in. As we note here, we do in fact get a swing bottom, and then prices have indeed continued up. As a matter of fact, they continue up until they moved into this overbought zone, which is above the 70 level. And notice here that as it trades above the 70, it eventually then breaks below it here. And this happens to also mark the top, where then prices proceeded to move lower. So this whole sequence from here to here was well indicated by the RSI's oversold and overbought indication. Now, as an overbought oversold indicator, this is not the RSI's strongest suit. There are going to be many situations where you really need confirmation from other indicators or other methods of trend change detection. But it is a good complement to other methods. Take, for example, here where the RSI moved above the 70, indicating that we were again in overbought territory. So it is telling us that as the bulls were in control here, as you can see this move up, then in this area right here, it was overextended. That's what we refer to as overbought. And usually when price is overextended, it likes to snap back just like a rubber band that's been stretched too far. As the RSI starts to dip below the 70, as seen here, and then it's starting to trade lower, we can see that after this short sideways action here, that prices then dropped quite a bit until it went oversold right here. Then it came back up, marking this as a low, and then it went all the way to here, where it just went above the halfway mark. You'll find that as far as the RSI going above the 70 and below the 30, that you will not get a lot of these indications in some markets, more in others. It all depends on what you're looking at and how much that market likes to trend and overextend in one direction or another. So now we're going to go into more powerful uses of the RSI. Okay, now we're going to talk about swing rejection patterns. For more precision, the RSI has a hidden gem, which are swing rejections. Imagine the RSI is approaching 70, as in this case here, but failing to reach it, and it starts to turn down. This shows that buyers are losing steam. And sure enough, as we see prices were rising here on this price chart, as the RSI is rising, it fails to actually reach and cross 70, and instead starts to turn down. This is an indication that the buyers are losing momentum. They're losing steam, and then we can see we had a number of straight bearish days that followed. Now, it's the same for the oversold condition. For example, we have multiple ones here to look at. Notice here that the bears are in control as prices are dropping here. The RSI is following suit, showing that relative strength is weakening. But notice, it doesn't really get down into that oversold, but then it starts to turn up. We can see here that the bears are losing steam, and we can see on the price chart the result of that. Prices reverse and move up. Here you can see an even better example. We are much further away from the 30. So as the RSI is moving down, you can see that it's failing to meet or go below the 30 line. Then it starts to turn up. And sure enough, the bears lost steam and the bulls took over. And here's an excellent example. Notice as the bears are in control as we move down to this new low. And we can see that the RSI also is moving lower, but it fails to hit the 30 level or go below it before it starts to now move up again. At this point, we see that we have a swing rejection and the prices start to rise back up again. This is an excellent example of swing rejections, where it just does not go into the overbought or oversold zone. For example here, which was one of our bearish divergence examples, we can see that it failed to reach the 70, started moving down, and that indeed marked the end of the buyer's strength and the bears took over. Now you may be wondering or asking yourself or asking me, but I can't hear you, well, wait a minute. When it's going down and it does not reach the 30 and then it starts to move up, at what point do we say, okay, that's the end of that down move and it is ready to start moving higher? I mean, if you really think about it, doesn't any of these little points here show that it fell short of the 30 and then just started moving up like here? Well, first, you got to be reasonable. That is nowhere near the 30. Neither is that or that or that. We're talking about these being more in the vicinity, right? Okay. But the question still remains, and it is a valid question. Thanks for asking. This is how I would answer that. Pay attention to the next section. Okay, the final section we're going to be talking about here is the multi-timeframe mastery. For best results using your RSI across multiple time frames. Let the daily chart, for example, show you the trend. You can use the hourly chart to fine-tune those RSI dips and to confirm those curl-ups on your daily chart. Let me show you a good example of that. Here, for example, we can see that prices were dropping. The bears are in control. We can see that the RSI is in full agreement that the bears are in control as it is trading below the 50 area and it's moving down towards the 30 or lower. But in this case, it fails to go to the 30 or lower, but instead starts to turn up. Notice it only took one price bar for that RSI to now flip up one. The question is, will it continue to do so for the next bar and so forth? Well, here, let's take a look. Notice the date down here as I move my cursor over that bar, and we can see it says August 6, 2024. Let's go to a lower time frame and see if that would have helped us. Let's go down to an hour chart. And I'm going to go back to August 2024. So here's August 5th. And then as we get into the hours here, here's August 6th. Now I want you to notice here that on the hourly chart for August 5th, it did in fact go into the oversold area, whereas in the daily, it got close. But now notice this. If you follow the hour chart, you can see that it actually crosses above the 50 level on the hour chart on August 8th at 8:30. So that would be like when the market actually opened on August 8th. So if we go back to the daily, there it is. If we go to August 8th, it would be this bar right here. And it would be at the open. So it'd be right in this area right here. The hourly chart would have told us that on the hour time frame, the relative strength is on the side of the bulls. This, as you can see, is marked right here well before this goes to the 50 line, which wouldn't be until August 15th. So here's your early warning, closing this gap, which is another little bonus, that this would be a good time to go on the side of the bulls, and that this indeed is a swing rejection, and we're moving up. And you can do the same for the bullish moves that fall short, for example, of reaching the 70 mark, the overbought mark. Trying to find a good example here. Here's one right here. And the reason I would pick this one here, for example, is because it had already gone overbought. It had dipped down to the 50, and going back over here again is likely just a retracement since this is an overbought top. You can go back to that lesson in the video about overbought oversold. So we see here though that it is moving up and then it turns down on December 26, 24. Now the question is, might this be an early indication that the retracement going back up has hit resistance? Well, sure, one of the things you can do is you can add Fibonacci lines, for example, and you can say, well, yeah, it's pretty close to like the 50%. In fact, it's a little bit over the 50, not exact, but it doesn't have to be. So you'd say, okay, we hit resistance, but could it be possible, though, that since it is a positive bar, it'll just keep going until it gets to the 62% and whatever. Okay, well, one thing you can do is take a look at December 26, 2024 on the hour chart. So go to the hour chart. And what was that, December 26, 2024? All right, so we're over here somewhere. Let's see, here we go. December 26, 2024. Again, we can see on the hourly chart, we can see where it made an overbought here, following the overbought of that previous top that we saw on the daily chart. But we did not see it on the daily chart for here, but we see it on the hourly chart. Isn't that interesting? So on the hourly, we can see that this is indeed overbought. But here's what you can do. Now, you can treat this like a regular overbought. When it crosses down below the 70, just go ahead and accept it that you got a swing top occurring on the daily chart. Or as we did before, wait until it crosses below the 50, which in this case would be December 27th at 2:30 Central Time, as you can see here. Going back to the daily then, here is the 27th. An inside bar was formed, but look at that. You can get in here. It's telling you on the hourly chart that this is a valid lower peak, and you can sell this. So using multiple time frames is really handy in letting you know the validity of any of these. For example, here Look at this. This is a bearish divergence. I think we covered this. Here we have basically a double top, or a triple top if you want to count these two here and here. But notice that this top that failed to reach the 70 again, as well as this one, are moving lower. That's our first indication we likely have the bulls getting weaker and the bears are likely to take over. But again, what you can do is you'll notice here, once it turns down, and in that case it occurred on March 8th, 2024, that price bar right there. And 2 days before the big drop, March 8th, go to the hour chart. March 8th is right here. And if you'll notice that come March 8th, take a look. On the hour, it had already started crossing below the 50. By 9:30 Central Time, 1 hour after the open on March 8th, it's confirmed to be that the bears are in control on the hourly time frame. This is early indication for us. So on March 8th, on the daily chart, right here, we already knew during the day that the hourly chart was indicating the bears were in control, and we had this curl down already happening here. We can accept this as a swing rejection, and we're likely to see prices start to move down. So you can see how valuable it is to use multiple time frames in confirming your swings using the RSI indicator. And next, we're going to talk about something that isn't actually one of the 5 things we just talked about, but we'll consider it as a bonus. It's one of my favorites, and it's using trend lines. As you know, most people, most traders, chartists, will use trend lines for one reason or another. Most don't really use it the way they should be used, but who am I to judge? But what I want to do is share with you that you do not have to reserve your trend lines strictly to your price chart. You can, in fact, use trend lines on your RSI indicator. Yes, you can, and it's very, very powerful. Let me demonstrate with an example here. Here, we can see that we have a top in the RSI. It comes down over sold, comes back up, and it makes this swing top in the RSI as this continues to move down to make this low here, which happened to be, as you remember, this is a bullish divergence. Remember, we have low to higher low on the RSI, but we have low to lower low here. Here we have low to higher low. Here we have low to lower low. This is a divergence. They're not doing the same thing. They're going in opposite directions. Okay, but let's now take a look at what we can do once we knew, or once we can see that we have 2 well-defined peaks. For example, in this case, you can put your trend line up against that peak. You can then make it go across this other peak, like right here. And then as soon as you see the RSI break above your trend line, this is a signal that the RSI is likely going to start moving up, just like any other trend line break. All right, let's try some more examples of that. There are going to be plenty, trust me, even in the small fry stuff. For example, you can put your little trend line right here. Look at all these little dip and so forth. I got 1, 2, 3 right here, and I move across here, and notice that right here we see the RSI breaking below the trend line. At this point, we know that it's going to start moving down, and that's exactly what it does here. It moves down. You got yourself a nice short-term trade of about 4 to 5 days. That's a decent move. Now take a look at this. Let me show you. It doesn't have to be just 1 week's worth of bars. You can see a bunch of peaks here. Just draw your line across it just like that, for example. Look at this. Bam, and there, and there, and there. Okay, and here. And then it starts to break above here. You know you're going to get a upward move. As soon as it breaks here, you're moving up. Nice move from here to here. And then, of course, you can do it like we just did here, and you get the nice move here. You can be doing this for every one of these swings. Let me get rid of that line. Here we go again. Simple thing. If you can see the little bottoms there, get about 2-3 touches. 1, 2, 3, 4. Something like that. Soon as it starts to break and trade below it like here, you got yourself a nice little move here, and you got this move right here. Okay, that is the power of using trend lines on your RSI indicator, because what it's going to do is give you a heads up that you're likely going to be moving in the opposite direction. If the RSI is moving in the opposite direction, price is likely going to do the same. So I might anticipate, I might start to put this trend line right here, for example. It's already gone once, gone twice. It could prove to be support. And if it goes and breaks below it, I'm going to be looking for the RSI to be going lower. If it comes here and starts curling up, I'm going to expect the RSI to be going up. Or for the current move right here, you can see it's already, the RSI is already turned down, for example, right here. So as long as it stays below here, I'm thinking this thing's going down. But if it ever comes back and breaks above this, I know I'm going to get out or go in reverse and go up. And you can just do this all day long. Look at this right here. Breaks below here, moves down. Here, moves down. And that's your bonus method using the RSI. Well, I certainly hope you all enjoyed these methods, these tips, these many powerful ways that you can use the RSI indicator, one of my favorite indicators. It's usually found on one of my charts when I analyze and time market tops and bottoms, which I have been doing for nearly 40 years now. And I'm sharing these things that I have found most valuable with you. So if you appreciate this kind of content, I would appreciate that you click the subscribe button so that you will get my future videos, and click that notification bell so that you'll be notified of them. And also, if you wouldn't mind hitting that like button, so that way YouTube can start recommending my videos to others. And with that, I look forward to sharing with you more indicator type tips in my future videos. Thanks again for watching.